Hi, have you ever heard of the three worlds of investments? The two stages of investing? How about in-service rollovers? Have you ever heard financial jargon called standard deviation? Have you ever wondered what the difference between real returns and average returns is? Well, folks, we're going to talk about all of this today, so stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Hi, welcome. Listen, in this segment, I want to talk to you about what we call the three worlds of investments. I don't care what financial instrument you look at out there, they're going to fall in mainly three different categories. First of all, there's the safe category. Okay, banks have their version. It's checking, savings, maybe CDs. Okay, insurance companies have their version. They're called fixed annuities. They pretty much look like CDs, but it's with an insurance company. And then the government has their version. They're called government bonds. I mean, literally holding directly the government bond. All these investments enjoy safety because they can't go down in principal, and they pretty much give you a fixed interest rate. So we call it kind of the world of the knowns. Then you have the other side of the spectrum, which are those riskier investments, okay? These are things that can go down in value, but your interest is not guaranteed because you don't know what you're going to make. There's a lot of mutual funds that, based on what their objectives are, can go down in value, but you don't know how high they're going to go either. Insurance companies have their version. They're called variable annuities, okay? Now, variable annuities are an insurance product. They can be complex in nature, but typically they have an account value which can go down. They might have an income feature which is guaranteed, which can't go down, but you better be understanding what the difference is. But so we call that the world of the unknowns. But then there's what we call this world that we call the hybrids, okay? It has an element of both those worlds. For example, a bank has its version. They're called equity-linked CDs, okay? Now, they're like a CD. They can't go down in value, but you don't know what your interest is going to be like a normal CD. It might be tied to some index. Let's say it's the S&P 500. So they're going to say, okay, you can't lose, but in this period of time, if the S&P 500's up, we're going to let you participate on that upside, but if it's down, none of the down. All right? So you can see it has an element of safety, but an element of risk too, because you might make nothing in that regard, but you could make a lot. You just don't know. Insurance companies have their version. It's called fixed indexed annuities. Okay? They're fixed in nature that they can't go down. But again, like a bank, an equity-linked CD, they might tie the upside to some kind of index. So again, let's say it's the S&P 500. S&P 500 from this point to this point is up. They're going to let you participate in some of that up, but again, none of the down. Listen, there's a lot of financial instruments out there. Probably pretty important for you to understand which category your investment's falling under, because if you're somebody that really wants something safe or want a hybrid, for example, and you're in the risky category, then you're going to want to make changes accordingly. So I encourage you, if you're somebody who wants to understand more your investments you have, give us a call.
Today's retirement challenges can be mastered. Knowledge is power because you can confidently plan ahead and make educated financial decisions for a successful and comfortable retirement. We are Centennial Wealth Advisory, financial advisors specializing in retirement planning, serving all of northern Michigan with offices in Traverse City, Cadillac, Petoskey, and Gaylord. And we invite you to an informative and exciting live event with a complimentary gourmet dinner. You'll learn highlights of the new Tax Reform Act, the difference between the fiduciary and suitability standard of care, how an IRA gets taxed to a surviving spouse, what a bull market is and how long it can last, and much more. Call 888-608-5825 to register and choose the date and location that works best for you. Wednesday, October 23rd at Big Buck Brewery in Gaylord. Tuesday, October 29th at Lakeside Charlie's in Cadillac, or Wednesday, October 30th at Boone's Long Lake Inn in Traverse City. The live event starts at 6 p.m. and is free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important live event. Educated Financial Decisions. Call 888-608-5825 today.
Hi, welcome back. Listen, in this segment, I want to talk to you about the two stages of investing. When you're in your working years, you're getting a paycheck, hopefully you're meeting your income needs. What you want to start doing is setting some monies aside for retirement. Okay, we call this the growth and accumulation phase of our lives, or the stage of our lives, because we're trying to save. We're trying to save for that great day when we can finally not have to work any longer. Okay, but when we get near retirement, or we soon to be retired, you know, we're entering a different stage, and it's very important to understand this because we're now entering what's called a preservation of wealth and income phase of our life. It's a whole different stage because we're rapidly getting to that place where we're not working any longer or not going to be working. We can't grow and accumulate assets anymore. We're going to have to rely on that nest egg for an income. So what's my attitude or risk tolerance now at this time? When I was in the growth and accumulation phase of my life, if my account dropped quite considerably in any one year, doesn't really have too much of an effect on my life because I have that paycheck, I have that income coming in, my needs are being met, and I have time for that asset to come back to where it was and possibly again grow. But if I'm getting close to retirement, I'm soon going to get there and I have to rely on that savings to now be income for me. Can I afford to have that account drop significantly? Do I have the time to be able to wait and have that come back? I might not. And folks, if I'm actually in retirement and I no longer have any other income but that portfolio, maybe Social Security, then it's going to have a drastic effect on my lifestyle. So understanding this stage and what stage I'm in is going to be very important because how I invest appropriately is going to be different under both those scenarios. So why are we having this conversation? We see too many times where people are coming in, they're getting near retirement or they're in retirement and they're invested exactly like they were maybe in the growth and accumulation phase of their life. Very, very dangerous because if in that previous stage that they were in, they were taking a lot of risk and now they're bringing that into this next stage, again, what are they going to do if the market drops dramatically and that income plan gets blown apart? So very, very important to speak to an advisor. We encourage you, give us a call to make sure that whatever stage you're in, you're invested appropriately. So give us a call.
Really good information there, Larry. And folks, I really enjoy talking about these two different stages of investing when we're talking about that growth and accumulation phase and then transitioning to that preservation of wealth and income. And I think, guys, we come across it way too often where folks just like you are preparing for retirement and maybe they have their 401k plan, 403b, what have you, IRAs, and they've been tucking this money aside for so long and basically getting to that stage where now they're saying, okay, I want to protect this money and generate an income stream, but they don't really know how to do that. And so we come across it often where these target dated funds. So Larry, maybe talk a little bit about what you mean, what would I mean by target dated funds?
Yeah, I'm glad you mentioned that, John, because I could do a whole segment probably on those and probably should. But a targeted date fund is really targeting the date you're going to retire, and then they're trying to make it more aggressive or conservative based on how long you've got to retirement. Sure. But what's funny is that last week I saw somebody, they had 5 targeted date funds they were in.
5 of them? Yeah, I've come across 2 is the maximum I've seen. But
I think they thought they were getting diversification by doing so, but they didn't realize that all it was a change in percentages. They really probably could have just put everything in the middle one if they wanted to split the difference. But really, you set the target date that you're going to retire, and then what the fund is supposed to do is invest appropriately, you know, based on how, and you would think though that as you would get closer to retirement, that would get, you know, much more conservative. Going back to 2008, 2010 target date funds, now they're guessing you're going to retire just in 2 more years, right? Yeah. Some of those funds lost as much as 30%. So they're not, you got to have them analyzed. You got to see what's behind them because they may not be as safe as you think.
Yeah, that's interesting, guys. And if you're out there and if you take anything away from this, know that if you're kind of getting inside that 10-year range to retirement or in retirement and you haven't had your portfolio reviewed lately, now's the time. You know, why wouldn't you take advantage of just a second opinion? Let us do a risk assessment of that and see where your portfolio comes in. Maybe you think you're diversified or think you're more conservative than you are, or maybe it's quite frankly, maybe it's okay. But let's take a look at that for you. Coming up in the next segment here, we're going to be talking about standard deviation and in-service rollovers. Two topics that Larry's going to dive deep into, and you're going to have a better understanding. So stay tuned.
Hi, my name is Jack Clunder and I'm a financial advisor with Centennial Wealth Advisory. My wife and I moved up here 13 years ago and we have really enjoyed raising our 4 children in the beautiful northern Michigan country that we have. If you've been watching the show for a while, you know what we specialize in. If you are at retirement or near retirement, give us a call. Call the number on your screen. We can help go through all the different aspects of planning that are involved in retiring well. So I look forward to hearing from you.
Hi, welcome back. Listen, in this segment, I want to talk to you about what's called in-service rollovers. If you're in a 401k plan, maybe a 403b plan at your job or your work, what you're going to want to know is it possible for me to roll that money over from my 401k, 403b into an IRA or even my own existing IRA if I have one? Knowing this is very important. Now, many people believe that they have to wait till they're done working before they can do that. But you'll be pleased to know that a lot of plans will let you do it before you're done working. Some will say, well, you can do it at any time, which would be desirable. Some say you might have to wait to a certain age, let's say 59 and a half. And again, like I said, some might make you wait till you're done. But knowing whether you can do it or not is going to be very important. Why? Well, as you're aware, when you're in a 401k, 403b plan, your investment options are going to be limited. The plan administrators do this because they don't want you to have 1,000 different choices. That makes their administration much, much harder. So they're going to limit how many choices you have. But what if I'm somebody who wants more choice? Maybe I don't like the choices they've given me. Then I'm going to want to maybe get it over into an IRA where the whole world is available to me. Because anything an IRA can be invested in is going to be open to me. My choices become greater in that environment. So it's going to be important for you to call your plan administrator, find out. The question you might want to ask them is say, listen, I have an IRA. When am I allowed to take my money from my 403b, 401k and roll it over into the IRA? And they're going to tell you when you can do that. So knowing that is going to be very important. Now, a lot of people will ask this question. Larry, if I do that, do that rollover, is that going to create a taxable event? I can assure you that that is not a taxable event. When it's a rollover, it's going from one custodian to the other custodian. You're never receiving the money. So in that kind of event, there's no tax consequences. As a matter of fact, there's not even any reporting that has to happen because you never took custody of it. So again, check with your plan administrator, see what they allow, And then if you're somebody that can do it or wants to do it, then give us a call, because then we can show you those investment options that you might not have right now that are available in an IRA. I mean, you can have an IRA invested in gold. You can have an IRA invested in silver. It can be invested in real estate. There's a number of things that it can invest in, may be more appropriate for you under the circumstances. So give us a call.
Are you an employee who's participating in a 401k plan? Are you aware that in some cases you might be able to roll out of the plan even though you are still working? Are you tired of the choices you have and possibly the lack of professional help in getting you to your retirement goals? If you're looking for an alternative approach to help you protect your hard-earned retirement savings, then we might be able to help. You may be entitled to an in-service rollover of your 401k plan. A rollover to a self-directed IRA may be an appropriate solution for you. Contact us at Centennial Wealth Advisory today. Take control of your retirement. Centennial Wealth Advisory can help. Please call the number on your screen.
Hi, welcome back. Listen, in this segment, I want to talk about standard deviation. Now, this is financial jargon that we use in our industry, but I want to make you understand what it is and why you want to know more about this, okay? First of all, this is a bell curve. It's going to represent, this line here is going to represent an average rate of return of 6%. Okay? Now, why we have this bell curve is we want to understand what could possibly be the range of returns, that could deviate from that average. So let's say we had a standard deviation that was equal to 10. Okay? All that represents is that there's a 68% chance that it could deviate from that average by 10%, either way. So 68% chance that we could have a minus 4% return or a plus 16% rate of return, okay? Now, in the bell curve, it also represents where the range of returns could deviate 95% of the time, but by another 10%. So in this particular case now, 95% of the time, we could see a range of return of minus 14 or plus 26. All right? Now again, based on the bell curve, represented by this line, it says that 99% of the time, the range of return could deviate another 10%, meaning we could have minus 24% or plus 36%. Now, why is that important? Let's say I'm somebody that only wants to lose 5–10%, maybe. Say 10% is the most. But based on an average rate of return of 6%, okay, and a standard deviation of 10, I could possibly lose 24%, 99% of the time, or gain 36%. So if I'm that person that only wants to lose 5–10%, but it's possible I could lose 24%, then I'm not going to be happy with that. Okay? Now what is this 1% that it's not representing? Those are black swan events. Those are unexpected things that happen that were unexpected that could drive it even farther from these ranges, meaning it could possibly lose 1% at a time, lose more than 24% or gain more than 36%. Now, look back 100 years, I dare say we've had more than just one black swan event. They happen a little bit more occasionally than we think they do, but that's what that's representing. Now, any portfolio we can take a look at, and we can look at the whole thing and actually tell you, one, what is its average rate of return, what is the standard deviation, so you know the range that you're comfortable with. Very, very important in risk analysis. So I encourage you, if you're somebody that wants to know that, give us a call.
Again, really good information there, Larry. And on this in-service rollover, guys, I think this is one that so often people aren't really aware of. And so again, it's something where while you're still working, contributing into your retirement plan, you have the option potentially within your plan to roll that money over to an IRA, and ultimately opens up a lot of different investment options. I think too often people are limited within their 401k retirement plan to a menu that they can choose from, but ultimately there may be some options that are available then to roll that money over. So you can ultimately communicate with your plan administrator and just find out, is that option available? And it opens it up not only from an investment perspective, but then potentially from a tax planning perspective to maybe convert to Roth IRA, all sorts of different options that ultimately come available with that in-service rollover.
Yeah, and that's interesting, John. You talked about opening up the options of an IRA, what's available. One of the things is when we look at those options, we're going to look at is that standard deviation that Larry talked about, right? And what that volatility, that range is. So often out there in the world today, people talk about averages, right? And it seems like there's this focus on averages. Well, that average may be a certain number, but what is going to be that range of returns that you're going to have to stomach to get back to that average? And so when we do a risk assessment here at the office and then kind of do a stress test on the portfolios, we want to know exactly what that standard deviation is so we can make sure that's within somebody's comfort level. So when we look at the old how much risk can you take on that you've heard us talk about in other shows, where that A is the attitude. Can you take those ranges of returns? You get out 3 standard deviations, like an 08, a 9/11 type event. Are you okay with what that might produce in your portfolio? So great timing. If you don't know what that number is, give us a call, right, Larry?
Yeah, and Art's right. I mean, we have the ability to analyze any portfolio, show them what their standard deviation is, how much risk they're taking on, and maybe lower that risk, that's more appropriate with their attitude. So now stay tuned, because the next segment, Art was talking about averages. Well, I'm going to talk more about that, the difference between real returns and those averages.
Today's retirement challenges can be mastered. Knowledge is power because you can confidently plan ahead and make educated financial decisions for a successful and comfortable retirement. We are Centennial Wealth Advisory, financial advisors specializing in retirement planning, serving all of northern Michigan with offices in Traverse City, Cadillac, Petoskey, and Gaylord. And we invite you to an informative and exciting live event with a complimentary gourmet dinner. You'll learn highlights of the new Tax Reform Act, the difference between the fiduciary and suitability standard of care, how an IRA gets taxed to a surviving spouse, what a bull market is and how long it can last, and much more. Call 888-608-5825 to register and choose the date and location that works best for you. Wednesday, October 23rd at Big Buck Brewery in Gaylord. Tuesday, October 29th at Lakeside Charlie's in Cadillac, or Wednesday, October 30th at Boone's Long Lake Inn in Traverse City. The live event starts at 6 p.m. and is free to attend with a complimentary gourmet dinner to follow, but seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important live event. Educated financial decisions. Call 888-608-5825 today.
Hi, welcome back. Listen, in this segment, I want to talk to you about real return versus average rate of return. 2 different things. So let me illustrate. Let's say you had an investment or portfolio that made or lost 50% the first year. Okay, it made 50% the second year. It lost again 50% the third year, and then again made 50% in the fourth year. Wouldn't you say that's a pretty volatile investment? Funny thing though, if you do the math on that investment, they would tell you that that portfolio or that investment averaged 0%. All right, but what if I had $100,000, okay, and the first year it lost 50%. That means now my investment is down to $50,000, okay? Then in the second year it made 50%. Now I'm back up to $75,000. All right, then it loses 50%. Now it's down to $37,500. And then lo and behold, the fourth year it's back up 50%. Now I'm at $56,250. Now, for an account that averaged 0%, this portfolio really lost 43.75%. Now, That's a big difference. And if you look at out there in most portfolios or investments, what is the return they're always trying to give you? Most generally, they're going to give you the average return. But the real return is much, much different. Now, I recognize that this is an example that's grossly exaggerated, because how many investments do you see losing 50% and gaining 50% year after year is? But very vitally important to understand the difference between the two different numbers, between real and average, because if I'm looking at my investments and I'm just looking at the average and it has a high degree of volatility to it, then what is really my real rate of return? Very, very important to understand, very important to know. If you're somebody that wants to know the volatility of your portfolio, most importantly, how it operated in 2008 in the last recession, so you can see what kind of volatility it could possibly have, then you're going to want to give us a call.
But, you know, and Larry, I think you could do a whole show or more than just on that, because it's really interesting. You know, this is an area that doesn't get talked that much about, and I think it really should. Especially we find ourselves in kind of a peculiar time right now where we've had a 10-year run in the market where we've pretty much just had mainly positive returns when you look at the major indices. A couple minor little spots there, but you know, we're outside of that 08 now, so when folks are reporting like a 10-year average, you don't really have any black eyes in there, so it can be kind of deceiving what maybe you're actually getting and compared to really what that range of returns is over time.
Yeah, so people may be thinking, okay, yeah, I'm getting a good return. I can count on this as I start to now build an income plan when it comes to retirement. That is so key when you're trying to map out, hey, what do the next 30 years look like in retirement? It's like 20 to 30 years of unemployment, so you need to have a consistent income plan, and it's so vital when we're looking at these real returns and we're looking at some of these numbers, Larry, and we see, okay, if that account drops 30, 40, 50%, whatever it might be, and you want to draw income, that has a major, major impact.
Yeah, I think the better statistic when you're looking at fact sheets is not the average, but when they show if you would have had $100,000 at this point, what would it really have been at a different point, sure, right? That's probably more of a real idea of how much it made. So anyway, folks, if you get anything out of this show, you got to realize that planning is very important. And when we're using averages, and we're using those averages in that income plan, that you got to be careful, because if the real return is much less, that can have a grave effect on that plan. The other thing is we can get behind any portfolio and go back almost 20 years and show, you know, go past that 10-year period, which for all practical purposes has been good, but let's see what it looked like in 08. How did it do, right? What was the drawdown? How much did that person lose? Very important. So give us a call.